As Nigerian banks release their 2024 financial year results, investors are assessing performance beyond strong earnings. Stanbic IBTC saw growth in net interest income and operating income, but rising impairment charges and tax expenses raised concerns. FBN Holdings, on the other hand, posted solid earnings, yet its stock underperformed Tier 1 peers, possibly due to recent controversies, maybe not. Sterling HoldCo showed operational efficiency. However, rising expenses question its profitability outlook. Well, joining me for more on this, I have Nabila Mohammed, banking sector analyst at Chapel Hill Denham Securities. Thank you so much, Nabila, for joining me again today.
Thank you for having me. Good morning.
Yeah, good morning to you. It's always a pleasure to have you. Now, let's begin with Stanbic. Stanbic's financial year 2024 performance showed strong growth in net interest income and operating income, but we saw the pressure it faced from impairment charges and tax expenses, particularly in the fourth quarter of 2024. Is that worrying or not?
I mean, it was somewhat expected if we look at the macroeconomic climate, dynamics in the environment, in the lending or borrowing environment that's facing it. You understand that there was still inflationary pressures even in Q4. We had the impact of the aftermath of the additional increase in energy costs towards the end of the year. So the impact was still felt in Q4, even before we started to see that reduced because of some clamoring around the marketers and all that. But it still left something in the environment, and banks are into the business of lending. Now, if the environment that houses these borrowers is facing such pressure, there's definitely going to be a step taken by the bank in terms of providing or provisioning rather for these loans that they give or they create for customers. So it is expected that we see cost of risk, that the payment charges now surging by that high, especially with the fact that Q4 also comes with a lot of activities and because consumers really like to spend more, so there may be increase in lending and increase in borrowing as well to be able to put all the bills that they have. So all these things would mean that the bank has to take additional provisioning for those loans that they create to customers. So it just explains the surge that we saw in impairment charges during the period, and that really translated to lower earnings. And I would say that this is even the first Q4 that we're seeing Stanbic see a drop in PAT on a Q4 standalone basis. However, if you look at it on an overall from an overall standpoint, 9 months performance was really strong enough to water down whatever impact Q4 came with. So it was an overall very good performance from a full year standpoint. And we still see that, as you rightly said, the interest income as well as other income lines did perform better because of the impact that 9 months 24 already brought to the entire performance of the holding for the period 2024.
All right, still on asset quality and capital structure. I mean, the cost of risk and NPL, that's non-performing loan ratio, both increased from 0.7% in 2023 to 4% in 2024. That's a lot. And then 2.4 in 2023, that's for NPL, to 4.2 in 2024. What do these point to?
I mean, it still boils down to the point I earlier made with regards to the macroeconomic environment and the inflationary pressures that we're hearing. And as you rightly said, we did see those two key ratios on asset quality increase, the cost of risk as well as the non-performing loans. And when we even did our analysis, what we realized was that the non-performing loans, that stage 3 loans from their books, did show an increase. In fact, it contributed around 80% of the increase in non-performing loans that we saw over the period, and it was largely from their business and commercial segment. So the business and commercial segment did suffer in terms of increase in loans that were non-performing. So this largely fed into the increase in the non-performing loans ratio during the period. And I believe that going forward, there will be more credit when administering credits to that particular segment of their entire group. There will be more meticulous, there will be more prudent in terms of administering loans in order to watch unnecessary surge in non-performing loans arising from that business segment.
All right. So very quickly, just before we leave Stanbic, I want us to look at the stock performance. Year to date, we have seen the share price surge 11.7%. Would have been more, of course, except for the 9.9% decline we saw on Friday. Was that profit taking or investors' reaction to the result? I mean, what happened on Friday?
So I would say it's a bit of both, a reaction and also profit taking, because prior to that day, the stock had risen around 24% on a year-to-date basis. And last time we saw Stanbic at that high was sometime early 2024. I mean, this is a stock that has traded as high as 18 naira per share. And if we're seeing that resurgence, because it did climb to around 71 naira, almost 72 naira before that profit taking happened post-release of the results. So I believe it was a bit of both profit taking, especially for investors that entered the stock at 50 levels or 55 levels. I mean, that's a very good margin to take profits from, and also a reaction to the result, especially when you look at it from a Q4 standalone basis and not from the entire year, which was still good given the strong performance of 9 months, the 9 month period that was earlier in the year. So I would say that it was a mix of both profit taking, given the rally that we have seen in the stock, and also a reaction to the results.
All right, so overall, what do you make of the efficient management of this particular company? I mean, before we then go to your verdict, whether buy, sell, or hold, I would like you to take the two together.
I mean, if we're looking at operational efficiency, it did come in better than last year. If we're looking at the cost-to-income ratio of the bank, it dropped by 9.3 percentage points year on year, which is quite massive because it came in at 37.7%, but was the 47%. It means that they were able to manage their costs effectively. That's one. Secondly, it also means that they were able to rake in more money through their income stream. That's talking about fees, talking about interest income, especially given the high interest rate environment that was throughout 2024. So all these things did feed into higher income vis-a-vis the expenses, and we did see that result in a moderation in the cost-to-income ratio for the bank. So I would say from an operational efficiency standpoint, the bank did do well. The entire group, the HoldCo, did do well in terms of managing expenses and improving income streams during the course of 2024.
All right, let's move on to FBN Holdings now. Now, the result appears to be good with strong earnings and EPS growth in 2024. But let me get your general comment on this particular result.
So for FBN, like you rightly said, this team performed very well, and showing interest income at 2.3 trillion, which is quite massive, especially for the entire holding. If we look at some of the drivers that really drove the performance, yes, high interest rate was one of them. We did see improvement in other income streams like fees and commission. We did see some level of fair value gains that were recorded. You understand that currency movements also contributed to those fair value gains that we saw. So overall, the earnings were strong, and we saw EPS come in at 20 naira, which is the highest that FBN Holdings have been in a long time. So all these did feed into the performance of the group, and I would say it is a welcome development because it's our view that with this improvement in earnings, it's largely going to fuel the bank's ability to pay more dividend or reward investors accordingly. Because as we know, in 2023, the dividend per share that FBN Holdings did announce was a bit lower than what they had paid in 2020. For context, what they announced and paid in 2023, what they announced was 40 kobo versus 50 kobo that was the final dividend for 2022. So I believe with this performance that we have seen them come out with in 2024, it could mean or translate to a higher or better than expected dividend for investors in that stock.
Okay, so still talking about FBN, we saw a rise in impairment charges and cost of risk, just as we saw in the other stocks. So talk to us, does this point to a sector-wide trend, and how does FBN Holdings compare to others?
So most definitely it is sector-wide because they are all operating in the same environment, in the same economy that is facing the same pressures from inflation, rising energy costs, just to mention but a few. So it's expected that these banks will definitely want to make or take adequate provision for the loans that they administer to their customers, and that will definitely translate to higher impairment. While we understand that it's based on management's discretion on how much it is going to administer to or it's going to be provision for a particular loan, it also boils down to the fact that these banks are taking cognizance of the environment that they are working in and providing financing to, and seeing the strains and the weaknesses that could potentially deter or have a ripple effect on their books in terms of they're looking at their loan book now, for instance, as well as currency movement and the impact that it will have. I mean, we did see FX. These banks also have FX lending that they do to clients. So if there is a material movement in FX, it's definitely going to make the value of the loan, of the FX loan, bigger in their books. So they would need to also take provisions for all these things, and that's what I would believe, or why I would say it is a sector-wide expectation. Because if we look at Zenith, for instance, even though they haven't released their results yet, as at 9 months, they did see that their cost of risk also surged, and it's largely because these banks were taking into cognizance or taking a position to provide for all the loans that would have gone extremely or have ballooned because of FX.
Okay.
Or the weaknesses in the environment and customers' inability to pay when serving their obligations.
All right. So, I mean, we saw what happened to FBN. Apart from the fact that the result was good to a very large extent, we also need to look at the year-to-date price performance, which is uninspiring and underperformed its Tier 1 peers in 2024, and even worse, year-to-date with a 3.7% return compared to its Tier 1 peers with 9.13%, and of course the banking index return of 11%. Now, can this be divorced from the controversy that plagued the bank recently?
I would say not necessarily. One key thing that investors also look at aside financial performance is also corporate governance. And if there are issues around corporate governance, it makes investors a bit wary around the stock or the investing in the company as a whole. 2024, we did see that was on several occasions, the AGM, that annual general meeting for FBN Holdings, did not hold or kept on being cancelled up until November when we eventually held the AGM. So all these things are questions that will be in the minds or worries that will be in the minds of investors with regards to pricing the stock appropriately. So even though financial performance will tell you that this is how much the value of the stock is really worth based on valuations and all that, it's also important for investors to really consider corporate governance, and I believe that is really what has fueled the lackluster year-to-date performance of the stock. I believe once things around corporate governance are adequately addressed, we will definitely see investors not reward per se, but price that into the stock price as we expect them to announce better than expected dividends given the performance that we have seen them deliver in 2024.
All right, buy, sell, hold. What's your playbook?
So generally, we are, from a general standpoint now, we are indeed bullish on the banking stocks because we do think that the entire sector is undervalued. If we look at the fact that these banks are all in the market to raise capital, that will mean the ability to pursue large ticket transactions and also sustain long-term profitability in the long run. So we have a buy rating on a number of the banking stocks, especially the ones that have all these things in place in terms of financial performance, the sustainability, as well as good corporate governance.
All right, Nabila Mohammed, banking sector analyst, Chapel Hill Denham Securities. Thank you for your time and insight on the show.
Thank you for having me.